Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, October 31st, and then we'll see how things look for Wednesday, November 1st. We are showing some signs of improvement. Unfortunately, growth is not really kicking into gear yet, but we've had 2 up days now. We're trying to regain some support levels. We're still negative, but we are showing some signs of improvement that I'll go through as we look at the charts. Let's go back and talk about what happened. Right at the open, we had a lower open and prices found support at the daily pivot at 41.59. It took us a while, but we were able to climb above the unchanged level and then eventually get above R1 at 41.85. And we closed at the high for the session. That's usually a good sign. We were up 0.65% on above average volume. We're still negative in the short, intermediate, and long term. We still have to get above a lot of longer term support, even though some is being recaptured. It's about inflation, interest rates, growth concerns. But in Wednesday's session, it's all about the Fed. The Fed is going to make their announcement at 2 p.m. Eastern. The market will react to that announcement. And then about 2:30 p.m. Eastern will be Jerome Powell's press conference, and they'll be hanging on his every word to try to read some secret meaning into what he is saying. We're keeping an eye on the geopolitical events, specifically in Israel, and then any of the different fallouts that can happen from any of the geopolitical events. Oil did close down at 81.02. That is helping the market. Now, oil and stocks, they can go up at the same time, but that's usually when oil companies are more in a growth phase. The reason why oil has been going up is because of Russia and Saudi Arabia, who came out and they're restricting the amount of production that they're doing, and that is pushing the price up for different reasons, and the market didn't really like that. Now it's starting to settle down just a little bit, but this could change at any time. The microcaps are still near a new 52-week low. In the short term, we pretty much have wiped off our list except for some of our stochastics charts. Intermediate term, the Erin is no longer extreme negative, but it's been acting kind of weird. The PMO studies looking better, but still somewhat extreme negative. And the S&P and the NYSE, both for the bullish percent index and the NYSE. Okay, let me back that up. Bullish percent index for the S&P and the NYSE, they are extreme negative, but at least for the S&P, it's starting to bounce back up a little bit. So we're seeing some improvement there. On a long-term basis, our 200-day moving average study, that's dropped off, but we still have the 150 on the list. And we're still dealing with this scenario, and some of this will be addressed with what the Fed says, that the economy is stronger than expected. The Fed will need to keep rates higher for longer and maybe even raise rates, even though it's very unlikely that they're going to do it in Wednesday's session. We're keeping an eye on the Chinese economy as they're adding stimulus to their economy, which may end up helping some S&P 500 companies. We're keeping an eye on events in Israel, also watching oil prices, and then we're dealing with earnings season. The dollar was up and interest rates were unchanged. And the 30 to the 5, the 10 to the 5, they're back to being normal, and I'll show you those charts. And I'll also show you charts of the 10 to the 2-year and the 10 to the 3-month, which currently remain inverted. Sentiment was unchanged. It came in at 31, where our previous reading was also at 31. It's negative, but after it had dropped below 25, now it's starting to tick back up. Our trend is still negative. The ADX is above its moving average and getting stronger, and both are above 20. So we are in a trending environment. But the red line's on top, even though it's coming down. Our bias is now positive with the 2 up days, and I've changed our momentum to mixed. There's a big variable as we're getting ready for the Fed to come out with their announcement and what they're going to say. We have a lot of economic reports coming out. We have positive seasonality in the background, but there's so many variables out there right now. I just wanted to keep it mixed until we see a little bit more evidence one way or the other. The economic reports that did come out, we had the Chicago PMI, which came in lower than the 45 they had expected. It came in at 44. Last time it was at 44.1. The employment cost index for the third quarter was in at 1.1% up. They expected it to be up 1%. Last time it was up 1%. The FHFA housing price index came in up 0.6%. Last time it was up 0.8%. The S&P Case-Shiller home price index, this really kind of lurched up here. It was up 2.2%, much more than the 0.3% they had expected. Last time it came in up 0.2%. Consumer confidence, not doing all that good, but it did come in better than expected at 102.6. They had expected it to come in at 100. Last time it was at 104.3. Here is the employment cost, and this is looking year over year, where everything is going down. You have the blue line, which is total, and then the yellow line, which are wages, and the purple line, which are benefits. They are seeing a decrease on a year-over-year basis. We look at the FHFA housing price index, where housing prices still continue to go up. That's hurting the market, actually, because you have interest rates going up, housing prices are going up, and a lot of people are having a really difficult time either selling the house that they are trying to sell, let alone buying another house that they may move into. And the Case-Shiller home price index declined just a little bit, but it still has been rising overall. We look at the year-over-year basis where it did spike up here to 2.2. The Chicago PMI, pretty much flat. It was down just a little bit based on the previous reading, but it has been declining over the last couple of months after it had been seeing some signs of improvement. And consumer confidence, we have the blue line, which is the total, which is taking everything together. It's declining a little bit. We have expectations looking out into the future. People are kind of negative when they are looking out. And then how do they feel about things right now? The present has also been declining. We were unchanged with the 10-year yield at 4.86. We're still above the 4.02%, which could start biting into company earnings. Here's the intraday chart where we ended up having a lower open, and we found pretty good support at the daily pivot, but we didn't really break off of that until later on. We were finally able to get above the unchanged level, and then it was later in the day that we were able to shoot up above R1, fell back a little bit, and then came back up and closed pretty much at the high for the session. But when you look at this, you see the red line is on top of the blue line. Well, that means that value is outperforming growth. And that's not necessarily a sign of strength. Also, when we look at this, we take the growth to value ratio for the S&P, it was negative. That is showing some under the surface weakness. And we look at the end of day chart where we really weren't all that much change, but we have been coming down. Now we've had 2 up days in a row, and this is not turning and going up. And that's a pretty big warning sign. Now this could change. They could kick into gear and start buying growth stocks, but right now we're just not seeing that. Looking at discretionary, it was up just slightly, but it's still in a longer-term downtrend. The staples are pretty much chopping sideways, also in a downtrend. We were pretty much flat with our ratio between discretionary to staples. Here's the condition of the trend. It's above the moving average, above 20, so that shows a strengthening trend. The red line's coming down, but it's still on top, so we default to negative, where the green line is trying to bounce back up, but is still quite a ways away. Short term, also, we're above the moving average, red line coming down. Everything that is moving right now is above 20, so that's a negative trend in the short term. I switched this over a little bit. Maybe we're seeing a little bit of a bounce as we were going down up here before we start to go down again with the VIX. This is just an average, and we're never going to mirror this completely. We're just looking for general trends overall, where maybe we'll start to go down now as far as the VIX is concerned. So when we look at the Ulcer Index, though, it's still continuing to go up. The VIX did decline with the line chart and the bar chart, and we're back under 20 now. So we've had 2 up days, and fear is decreasing a little bit based on this chart. We're also seeing volatility really starting to drop with the bar chart and the line chart when we look at the VIX of the VIX. But we're still going up longer term with the VIX to VVIX ratio. We're also going up with the VIX to the 3-month average of the VIX, and I follow the red line, and it's continuing to go up. The VIX to move ratio is coming down as stocks have been going back up, and we're getting a little extreme again here. This is the 5-period simple moving average of the equity put call ratio. We're just under this 0.8 level. We're at 0.79. Are we going to top out? Is this one going to mean something this time? And then are we going to turn and start to come back down? That could be positive for stocks, but as long as this is going up, that continues to be negative. Longer term, we continue to be negative with the 253-period simple moving average. We're also continuing to go up with this fear gauge, and our other fear gauge ticked down just a little bit, but it has been spiking recently. This is another warning sign. The risk on risk off ratio continues to decline. It was down in Tuesday's session, and it is in more of an intermediate term downtrend currently. When we look at the advanced decline line based on price and volume, we're seeing some improvement, but we're still below the moving averages. And we're still not really seeing an expansion of any new highs. We're seeing a contraction of new lows, which is an improvement, but we want to see the new highs, the green area up here, really start to go up. So we're still declining with the 5 period and the 10 period. We're still below zero with the advanced decline ratio, even though we're showing some improvement. Also, some improvement with accumulation distribution, but we're still below a declining moving average. The Chaikin money flow is looking a little more positive. If we can stay above this moving average, that'll actually start to turn up and get back above zero. So this is suggesting that there's some improvement happening. We're coming out of this low that we set here, but we still have the 200-day moving average above current prices. We still have this pivot level, but on the bottom, you see where we were above average. And we've been staying above average more in the longer term now. And we're no longer extreme here. The 20-period exponential moving average is now turning up. We're right on the 20 reading here for the 50-period exponential moving average, and we're turning back up slightly with the 200-period moving average. The force index still below zero, but showing some improvement. It's still negative. Here's our stochastics. We're no longer extreme in the short term. We're still extreme, but improving in the intermediate short term, turning up, but we have not crossed above the moving average in the long short term. The Arun, this is the one that's acting kind of strange right now, where it was getting extreme negative, and then out of nowhere, this green line just shot up. It's now starting to come down as the sellers are coming down. So our oscillator is still below zero, but it's pretty much treading sideways. In our cumulative advanced decline line for the NYSE, it is showing some improvement, but we need to get back above the moving average and see the moving average start to turn up. We're seeing some improvement with our regular advanced decline line. When we look at the other NYSE advanced decline line, we're ticking up, but we're still working off of a death cross here, showing that the overall tendency is for the advanced decline line to go down. This is for the 4th day now, something that's potentially positive. The Swenlin trading oscillator based on price and volume, they're still negative since they're below zero, but they have been increasing and going up. Another day or two with some positive price action, and these could actually cross above zero. The go, no-go system has changed from being a deep purple to more of a pale purple. The TTM squeeze continues to decline. The balance of power ticking up a little bit, but is still negative. And we're turning up just slightly with our lowest low value, but the midpoint continues to drop. We're going to need to get back up to the midpoint and go above that for this to turn more positive. We're still below the 200-day simple moving average, even though we're showing some improvement. And we're bouncing up off of, we don't know if this is actually going to be some kind of a low, but once we got into this area, we went over that 10% reading, which officially threw us into a correction, and we're bouncing up out of that. So we're no longer in a correction if you go back to the July 31st high, but we still have a lot of repairing that needs to be done. The vortex continues to be negative, although the red line is coming down and the green line's going up. The Copic curve is also negative. The ease of movement turning up slightly, but still below zero, that's negative. And we're starting to bounce back up a little bit with the bullish percent index for the S&P. And we're crossing above zero with the S&P 500 McClellan oscillator. That's turning things a bit more positive. And so when that turns positive, that means we're starting to turn up based on price. We have another indicator in the bottom, which is calculated in a different way. Sometimes this can lead price where we're turning back up based on volume, but we need more confirmation of that. We're also crossing back above zero with the NYSE McClellan oscillator. So that's a broader market look at things improving. We're just barely starting to tick up with the summation index for the NYSE based on price and volume. And we're still remaining neutral for the Elder's Impulse system for the S&P. And the standard deviation, we're starting to come back down now as the market has been settling down just a little bit, where it was really moving pretty fast as we were going down. As we're chopping a little bit, we're going up now, but we're not seeing any real explosive moves up. So the standard deviation is starting to get a little bit more tame. The RSI in 14 periods still negative, but showing improvement, as well as the 9-period RSI. On balance volume ticking up, it's still below a declining moving average, showing some improvement with our 200-period moving average study for the S&P, as well as our 50-period moving average study. And we're still back above this 100% retracement level here. That's in the short term, and that can be seen as positive as this support level holds. Longer term, we're coming back up above the 50% retracement level. So we've been able to recapture that. And we're coming back up to this longer term double fib level on our long-term Fibonacci chart. These are two fib levels on top of each other, and they're at about 4208 right now. If we can get above that and close above that, that will turn things more positive. And we're coming back up above this quadrant line here at the 75% level. We had lost that. We're now starting to come back up. That is seen as positive. Showing some improvement with the PMO study, where we're going a little bit higher with the percent of PMOs that are rising. Turning back up with the buy signals, flattening out, but still extreme negative with the PMOs that are above zero. We're on a momentum basis, though, we're still negative. We're declining with the PMO, both based on price and volume, even though they are starting to turn up. And we're just a little bit below the NYSE bullish percent index of 30. That can be considered to be an extreme negative reading. If we climb back above 30, that could be pretty positive, although it didn't really go down all that far. The NASDAQ 100 bullish percent index, this is a bit of a warning sign. We're continuing to decline here, and this has been the real leader in 2023. We want to see this start to go back up. Right now, it's continuing to decline and is not quite extreme negative. On a momentum basis, in the short term, our slope oscillator is negative and starting to get extreme. On an intermediate term basis, the MACD is flattening out, but still negative. All of our oscillators are still negative across the board, short, intermediate, and long term. We're still below the 200-day simple moving average. And as we stay below this, these other squiggly lines, other moving averages, are starting to come down. If we do start to take off to the upside, they could easily act as overhead resistance. And we've recaptured the anchored moving average going back to the all-time high. And this is the second day we've been above that. And we're coming up to the border between the -1 and -2 standard deviation. So this is showing some improvement and no longer extreme. The Chaikin oscillator is starting to show some improvement, but is still negative after getting extreme negative. Turning back up slightly with the money flow index, but still below 50. Ultimate oscillator showing some improvement, but still below 50. We're no longer extreme negative with the Sean trend meter, but we're still negative with the parabolic SAR. If we see an upward move, we want to see the dots come underneath for things to turn more positive. And we're coming right back up to this parallel trend line, which is the green trend line that you see here. We haven't been able to quite cross above that and close above that, at least yet. Here's our longer term moving average study. We're turning up with the 150. It hasn't gone back above this level where the 200 already has. And our special K daily chart continues to be negative. That's longer term negative. And looking at traditional Dow theory, we saw a bit of a bounce up with the Dow, the transports, and the utilities, but nothing really strong yet. The transports continue to underperform the Dow. We also look at the ratio between the transports and the S&P, ticking up just a little bit, but in the bigger picture has been underperforming. The Dow is still continuing to outperform the transports, even though this ratio ticked down slightly. The Sahorchak is still coming off of a full-blown buy signal. It came down here. If this goes back up to the top, that could be quite positive. And when we look at the Staples and S&P 500 ratio, this overall has been going up, and that is negative for the S&P. Yeah, we ticked down just a little bit on Tuesday, but we need to see this really turn around and really start to come down to change things more in the S&P 500's favor. This is an opposite look. The S&P is still underperforming utilities. When this is going up, that tends to be good for the S&P. As it's going down, that can be negative. The 10-day average of the S&P 500 highs minus the lows, we're starting to get another extreme reading now. So we just had one not too many days ago. Are we going to be able to bounce up out of that? The advanced decline ratio based on 19 periods we're still below the zero line based on price and volume, although we showed a bit of an improvement. We're still really near the 52-week low for the micro caps. We're turning a bit more positive with the Heiken Ashi. We have an open candle, but with the KEGI, even though we're still pointing up, it's red. We're still negative with the Renko, and we're still negative with the 3-line break. We're showing some improvement with the equal weight index, but it's still underperforming the S&P 500 weighted index. The ratio is hanging in there, and as I usually say, there are two ways to look at this. It just means the 7 big companies, well, they're just doing better than the rest of the market, and the rest of the market's really underwater. That's the negative side. The other side can say, well, the big companies are holding up, even though we've been under some pressure lately. That could be positive for the market. And then the Dow is bouncing back up. We're still above this pivot level where we were holding above this previous pivot level, but we're still below the 200-day moving average, and this could produce a death cross here pretty soon. The diamonds remain neutral, and the NASDAQ 100, we're still maintaining support at this pivot level. We need to see this go higher. We never came down to the 200-day simple moving average, and maybe we won't, but if we really start to fall, we'll be watching that level. And we remain neutral for the QQQs. On a momentum basis, we're still negative, even though the PPO is trying to turn back up. We're below the moving average and below zero. And we're coming right back up to the 61.8% retracement level. We closed just a little bit above it in Tuesday's session. And looking at the NASDAQ, we're still just a little bit above the 200-day simple moving average. And to recapture that is positive, but now we need to see follow through with price. Looking at the fib levels for the NASDAQ, we're still showing some improvement, but we still have a ways to go to get back to this 50% retracement level. We're still negative with the small caps, even though they're bouncing up after coming down to this pivot level, which is acting as support. And looking at the Russell 2000 small caps, we're seeing some improvement with the RSI, still working off of a death cross. Momentum improving, but it's still negative. And the small caps remain neutral for the Elders Impulse system. We're still showing some improvement with the mid caps as well. We're above this pivot point, but we just generated a recent death cross, and we remain neutral for the Elders Impulse system for the mid caps. The FANG index was virtually unchanged. It was up slightly, but it's still below its 50-day moving average. Longer term, it's still in an uptrend. And we're still above these intraday lows, and that's positive. So right now, this support level is holding up. But we need to see this really move back up. If we start to turn and go down, we're going to break through these levels, and it's going to make things look more negative. I wanted to show this. I don't invest in ARK, but a lot of you might do that. We're seeing a death cross on the daily chart here that was triggered after Tuesday's session. Longer term, the S&P weekly chart was still below this long-term trend line going back to 2009. Looking at growth versus value, we're seeing a little bit of improvement with the Qs to the S&P. We're pretty much flat with discretionary after we had a good day on Monday, and we're pretty much flat with large cap growth versus large cap value. So when we look at the different growth to value ratios, we're right on the moving average with the large caps, seeing a little bit of an improvement with the mid caps, and we're pretty much flat to declining with the small caps. Longer term, our new highs minus new lows study continues to decline. We look at the next chart. That's because the black line continues to be below zero. That's bringing the 50-period moving average down with it. Looking at the stocks in the S&P 500 above their 50-day moving average, we did get extreme negative. We're seeing some improvement coming back down. This did shoot back up just a little bit on Tuesday. Looking at the mid caps, we're still really close to an extreme negative reading, but they bounced up slightly. And the small caps also bounced up a little bit and didn't quite get to an extreme negative reading. The broad market look at the new highs, new lows, and a 5-period moving average did tick up just a little bit, but we're still well below zero. So this is showing some improvement, but it's still negative. The dollar continues to be in an uptrend and was up in Tuesday's session. The financial sector has a recent death cross and continues to be below its 200-day moving average, even though it was up over 1%. We're still above this support level for right now, so that part is looking more positive. Interest rates were virtually unchanged on the 10-year yield in Tuesday's session. The 30 to the 5 has gone back to being normal. The 10 to the 5 continues to be normal. The 10 to the 2-year is still inverted, but showing some improvement. And the 10 to the 3-month also showing a bit of an improvement, but is still inverted. We're still getting a positive result when we take the 10-year yield in the US and subtract the German 10-year yield. That's continuing to go up as the dollar's going up. So the correlation between the two is quite strong. I don't have the latest research for Tom Bowley for November. I just have to wait until that comes in an email. So what's our outlook for Wednesday? We do deal with earnings season on a day-by-day basis right now. Apple will be reporting on Thursday. That tends to be quite a major event. We're still watching the geopolitical events that are going on in Israel, wondering if there's going to be an even more escalation. And Israel is just throwing the idea of a ceasefire out the window. They're like, okay, this is just something we can't even contemplate right now. Bank of England will meet on Thursday, and we'll hear about their results for interest rates. The technicals are still negative, but we are showing signs of improvement. We're going to get a big slew of economic reports in Wednesday's session. The MBA Mortgage Applications Index, the ADP employment change, the S&P Manufacturing PMI, the final reading, construction spending, ISM manufacturing, that's a big one. The JOLTS job openings, the weekly MBA Mortgage Applications Index, and then to top it all off, the little whipped cream on top, the FOMC will be coming out with their rate decision at 2 p.m. Eastern, followed by the press conference, which roughly starts at about 2:30 p.m. Eastern. And then the whole list of geopolitical events that we are watching. Here's the economic calendar. We're going to get productivity and unit labor costs on Thursday, but then the big report is going to be on Friday with the employment situation report, as well as ISM non-manufacturing. Here's the new statistics, and I'm going to take just a second to go through this. This is, and I should have changed this to November. I changed all the other stuff, but not the name of the month. November tends to be the best month of the year. Okay, over the last 72 years, we've been up 68% of the time, down 32% of the time. I'll deal with options expiration as we get closer. But when we just look at November 1st, we are positive across the board with the Dow, S&P, and NASDAQ. This is the first trading day of the month where when we look at the green dashed line, it's not all that great. Historically, it looks a little bit more impressive. And then I've shifted the boxes over here where this is the green line where we have a sitting president who's running for a re-election. This tends to be a pretty strong month historically. And here's another chart that I found at isabelnet.com, where right after the end of October, we do tend to see some positive seasonality. And this is going back to 1928. And then looking at the NASDAQ, I shifted the box over now where the NASDAQ tends to do well up until about the middle part of November. The S&P also does pretty well until the middle part of November, and then it pulls back before we end up historically finishing strong. Here's the Bitcoin, where now we're kind of starting to come into this part where the seasonality, the honeymoon tends to be over a little bit here. We might have a few more days of this before we start to see things go down. Now, that's when you look at the green line. If you look at the blue line here, which is 2011 to 2017, the party's just getting started, and it's just going to go up from here. And the black line also shows some real improvement. Here is Bitcoin, where it's kind of chopping around the 34,000 area right now after it got up into the 35,000 area. So our scenarios, we still have to go with the down one. We're seeing a lot of an improvement in our charts, but we're still below long-term support and we're still negative. We can't really go with the up one right now unless you want to just totally focus on seasonality. There's really no support for that in our charts. And we're not going with the sideways trend now because the ADX suggests that we're in a trending environment. The warning signs, this list is still kind of strong, or it's kind of long, I should say. The daily special K chart is looking more negative. The equity put call ratio on 253 periods as well as 5 periods, they're both going up. And until especially the 5 period turns and comes down, that'll be more short to intermediate term positive. Longer term is when the 253 period starts to come down, but we're just not seeing that yet. The risk on posture continues to show weakness. On a momentum basis, we're seeing an improvement with the S&P and the NASDAQ, but we're still negative. The BPI for the S&P 500 is back below 30, but now it's starting to come back up, but it hasn't crossed yet. The vortex and the parabolic SAR continue to be negative. Our longer range look at the new highs, new lows with the 50-period exponential moving average study is still negative. The Russell, the small caps, and the mid caps are working off of recent death crosses. And the financial sector generated a death cross as of last Friday. We just have one little thing here. Now, yes, there are other positive things. What I try to put on this slide are just the things that I don't always show in the charts. You can pick out some of the other things that I actually showed you. But small and mid-cap growth, it's chopping sideways, but it's still in a longer-term uptrend. So our conclusion, we're negative, but showing some improvement. Now, that could all be lost if the market just decides to tank in Wednesday's session, and then we'll fall back and regroup. But we still remain below long-term support. We're no longer considered to be oversold in the short term. We are showing signs of improvement. Intermediate term, we're improving, but we're still below longer term support. And we're still negative in the long term because we're below the 200-day simple moving average. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.